Greetings, everyone. Welcome to the Liberty Call. It is Wednesday, November 16th, 2022. Hope everybody's having a fantastical day out there. I had to do a little maintenance on the beard. It was getting a little unruly, so hope it looks good for everyone out there in the interwebs. If it's your first time watching, please give me some big old thumbs up. Hit the like button, subscribe, and all that good stuff. Share it with friends and family. I'm sure with everything that's going on in the economy and the markets, there's probably folks out there who have some questions. So I know someone who can help them. This guy right here. Anyways, all right. Kind of a back and forth day in the markets. Everything looks kind of very red right now, just looking at the closing numbers. But looks like tech took it the worst today after a couple of days where things were looking pretty good. But hey, those things do happen. I personally think we're headed for, continuing this bear market for quite some time, at least probably until early next year, mid next year would be my estimate. But, that's kind of conditional on, is the Fed going to come right into the rescue like they have in previous downturns and, drop money out of helicopters. But, we shall see. All right. Well, let's go ahead and jump in and look at the numbers for today. The Dow Jones was down not too bad, 0.12%, closed at 33,553. The S&P 500 was down 0.8%, closed at 39.59. NASDAQ was down the worst, down 1.54%, closed at 11,183. Small caps were down almost 2%. The VIX actually fell today, which is a little odd. It was down 1.75%. At 2411 is the current reading. Canada was down 0.18. Brazil was down 2.66. Mexico was down 0.28. Jumping over to Europe, Germany was down 1%. UK was down 0.25%. France was down 0.52. The Euro stocks was down 0.83. Netherlands down 1.02. Spain down 1.06. Italy down 0.68. Switzerland was down 0.81. And Portugal down 0.35. Moving further east, both Russian exchanges were in the green. The MOEX was up 0.18. The RTSI up 0.34. And let's head over to the Asian markets from overnight. Japan was up 0.14. Australia was down 0.27. The New Zealand markets seem to, I guess they've already opened up. It shows it's flat. In China. The Shanghai was down 0.45. The SESE component down 1.02. The China A50 down 0.58. DJ Shanghai down 0.55. Hang Seng down 0.47. And the Taiwan weighted pretty much flat, down 0.06 for the day. So, like I said, mostly red across the screen. But again, it's certainly not the end of the world. We've been on a nice rally. I personally think we're going to fall back into the trend we've been in for quite a while now, since I think January 3rd or 4th when the downtrend started. So I don't think we've troughed out yet. But again, I could be wrong. I'm not perfect, but just, understanding how these things work and, just looking at the overall bigger picture, I think we have a ways to go before markets across the board bottom out, at least here domestically. I can't necessarily speak for the international markets. All right, well, let's go ahead and read through today's market recap. S&P 500 stumbles on Micron-led plunge in tech, renewed hawkish Fed fears. Ooh, yeah, the Fed might raise rates too high and everyone's going to freak out. All right, the S&P 500 slipped Wednesday as better than expected retail sales data pointing to underlying strength in the economy renewed fears of more hawkish Federal Reserve monetary policy tightening. Yeah, can't let those rates get up to where they would be normally. The Commerce Department reported that retail sales rose 1.3% last month, topping estimates for the 1% gain expected. Retail Sales Control Group, which has a larger impact on U.S. GDP, rose 0.7%, beating expectations for a 0.3% rise. The strong data is a, quote, decent indication that nominal demand remains fairly robust, suggesting that the Fed still has more work to do to bring it in line with aggregate supply, end quote, Jeffrey said in a note. Tech stocks took a breather from the recent melt-up following pressure from Micron-led slump in semiconductor stocks. Micron Technology fell more than 7% after the chipmaker warned that the market outlook for 2023 has weakened and cut capital expenditure amid plans to trim supply. Quote, We do believe there is potential for a longer demand trough that would potentially weigh on the broader technology space. In quote, Wedbush said following Micron's announcement. Target fell 13%, pushing the broader retail sector deep in the red after the retailer reported a 50% slump in profit and cut its fourth quarter guidance, warning of a weaker holiday quarter. Ooh. Yeah, that third quarter that was in the positive for GDP may be an aberration. Lowe's rallied nearly 5%, bucking the trend lower after reporting third quarter results that topped analyst estimates. I do my part. I do a lot of my shopping at Lowe's. Advanced Auto Parts fell 15% after reporting quarterly results that missed on both top and bottom lines, prompting a string of downgrades from analysts on Wall Street. UBS downgraded the stock from neutral to buy, while Wedbush cut its price target on the stock to $165 from $200. Despite the move lower in the broader market, some on Wall Street continue to bet that stocks will likely grind higher into the year end, though the advance isn't likely to be smooth. Quote, we like the markets overall to push modestly higher into year end. However, this should not assume it will be a smooth trade, as macro uncertainty remains elevated even after some of the inflation data has started to cool, end quote, Janie Montgomery Scott said in a note. So, looks like business is slowing down, which I know the Fed is going to be happy about that. From a economy perspective, but at the same time, we still have a ways to go. All right. Next up, U.S. retail sales rise solidly. Fourth quarter GDP estimate raised. U.S. retail sales increased more than expected in October as households stepped up purchases of motor vehicles and a range of other goods, suggesting consumer spending picked up early in the fourth quarter, which could help support the economy. The solid retail sales reported by the Commerce Department on Wednesday and signs of a slowdown in inflation raised cautious optimism the economy could avoid an anticipated recession next year or experience only a mild downturn. Again, I don't think that's going to happen. I think it's going to be pretty rough out there. While other data showed manufacturing production barely grew in October, business equipment output remained strong. Continued strength in consumer and business spending will keep the Federal Reserve on track to tighten monetary policy further, though subsiding inflation gives the U.S. Central Bank room to scale back the size of its interest rate hikes. Quote, this is not what the Fed wants to see, but it comes at a time when inflation numbers are starting to improve, end quote, said Eugenio Ailman, chief economist at Raymond James. Quote, this will keep the Fed on guard and committed to continue to increase interest rates in order to slow down economic activity, end quote. Retail sales rose 1.3% last month after being unchanged in September. Economists polled by Reuters had forecast a rise of 1%. Sales increased 8.3% on a year-on-year basis in October. Retail sales are mostly goods and not adjusted for inflation. While inflation cooling considerably in October, economists estimate retail sales increased 0.9% last month. One-time tax refunds in California, which saw some households receiving as much as $1,050 in stimulus checks, likely helped underpin sales in October. In addition, Amazon held a second Prime Day promotion last month. The broad increase in sales in October was led by motor vehicles, with receipts at auto dealers rebounding 1.3%, reflecting significant improvements in supply. Sales were also buoyed by higher gasoline prices, with receipts at service stations rising 4.1%. Online retail sales jumped 1.2%. Furniture stores sales increased 1.1%. Sales at food, services, and drinking places, the only services category in the retail sales report, increased 1.6%. But electronics and appliance store sales slipped 0.3%. There were also decreases in receipts at general merchandise stores, as well as sporting goods, hobby, musical instrument, and bookstores. Clothing store sales were flat. The National Retail Federation is forecasting holiday sales will grow between 6% and 8% this year. While that would be a step down from the 13.5% notched in 2021, it'd be well above the 4.9% average over the past 10 years. The upbeat outlook for holiday shopping was somewhat tarnished by Target Corp forecast on Wednesday of a surprise drop in holiday quarter sales. The retailer blamed inflation and dramatic changes in consumer behavior for a drop in demand for everything from toys to home furnishings. Stocks on Wall Street, we already talked about the Wall Street. So looks like some things are still doing pretty good. And, we still will probably have a decent fourth quarter. I just don't think it'll, if it is in the positive, I don't think it's going to be dramatic, if anything. So, all righty. Next up, article from our Treasury Secretary, U.S. Treasury Yellen says crypto markets need better oversight. Yeah, because, government regulation always seems to fix the problems. No, it doesn't. All right, let's dive in. U.S. Treasury Secretary Janet Yellen said on Wednesday that crypto markets need more robust oversight days after cryptocurrency exchange FTX collapsed. Quote, the recent failure of a major cryptocurrency exchange and the unfortunate impact that it has resulted for holders and crypto investors of crypto assets demonstrate the need for more effective oversight of the cryptocurrency markets, end quote, Yellen said in the statement without directly naming FTX. Treasury and other regulators had identified risks in crypto markets over the past year, including commingling of consumer assets, lack of transparency, and conflicts of interest, which were at the center of the crypto market stresses observed over the past week, end quote, Yellen said. Consumer protections should be rigorously enforced in crypto markets, and the federal government and Congress need to move quickly to fill any regulatory gaps, Yellen said. Yeah, because these people, they've never seen anything that they don't want to regulate. I mean, they'd like to come to your house and tell you how to cook your dinner. I mean, it's just ridiculous. While the damage has mostly been contained within crypto markets, its links to the traditional financial system, quote, could raise broader financial stability concerns, end quote, she said. Her remarks largely echo concerns voiced by banking regulators at 2 days of congressional hearings at which they said spillovers have been limited from the FTX collapse and other upheavals in the crypto markets this year. Yeah, these folks just really want to push the crypto business out. They'd like to have their own central bank digital currency, which then they can turn off your wallets or your accounts at any given moment, especially if you're one of the people that they don't like. That's why I'm very against it. I'd like to see the government stay away from currencies because we can see government manipulation and how it's affected us over the last 2 years where, at any moment they can just increase the supply of currency and boom, we now have massive inflation. I personally would like to keep my assets from being devalued when they're just sitting somewhere safe. But again, do your due diligence. I mean, it's still wrong to steal other people's property and use it for other means, which this Yahoo did, Sam Bankman-Fried. Because theft is still, it's illegal already. So that didn't stop the guy. And who knows, he may not be the one who did it. It could have been someone underneath it. But, seems like he took a lot of that money and donated it to one particular political party, which again, you're welcome to do so. Just don't steal other people's money and give it away. That's kind of my view on it. All right. And a little bit of tax planning. Let's go ahead and read through this article. 11 states that don't tax retirement income. So if you're getting close to retirement age or you're thinking about where you want to park yourself after you're done with your working years, so here's some states that don't tax your retirement income and you get to keep more in your pocket. All right. States vary widely in the way they tax retirement income, so location is an important consideration in financially planning for retirement. Some states don't levy Some states don't levy income taxes on any sort of retirement income, while others tax IRA and 401k distributions, pension payouts, and even Social Security payments like ordinary income. Income taxes are just part of the story. However, as some states with low or no income taxes have high property taxes, sales, and other taxes, consider working with a financial advisor when you're planning for retirement to make sure you avoid any unnecessary taxes. And if you need to find someone, I could probably point you out to somebody. And if I can't help you, I'll send you off to someone who can. Most retirement income can be subject to federal income taxes. That includes Social Security benefits, pension payments, and distributions from IRA and 401k plans. Exceptions include distributions from Roth IRA and Roth 401k plans. Federal income taxes on Roth contributions are paid before the contributions are made. These contributions, as well as any investment gains, can be withdrawn free from federal income taxes after 5 years if you have reached age 59 and a half. Or you can just leave the country and liquidate all your assets. Don't pay the government a dime, and as long as you plan on never coming back. So again, I'm not a tax advisor, so take that with a grain of salt. But if I was never coming back to the United States, I'd liquidate everything and they'd get the finger as I leave. The situation is more complex when it comes to how states will tax your income. Many states have no income tax at all, so all retirement income as well as other income is state tax-free. Most states specifically exclude Social Security benefits from taxation. Some others also exempt retirement account distributions and pensions. Most have a mix of approaches of taxing retirement income. Now that you have a good baseline of knowledge of how retirement taxes work at the state level, let's dive into the states that won't tax you at all. 8 states have no state income tax. Those 8 are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Don't tax wages, salaries, dividends, interest, or any sort of income. No state income tax means these states also don't tax Social Security retirement benefits, pension payments, and distributions from retirement accounts. Even income from securities held in non-retirement brokerage accounts is free from any state income tax in these states. That means retired residents in these states have no worries about paying state income taxes on their income from any source. But having lived in Texas a good part of my life, you do have high property taxes, and that's where they'll get you. So that's why I live in Colorado. Even though I pay state income tax, I'm still coming out on the better from a keeping money in my pocket perspective. Another state, New Hampshire, has no state income tax on wages, salaries, retirement account withdrawals, or pension payments. But New Hampshire does currently tax dividends and interest, which are likely to be sources of income for some retirees with assets outside retirement accounts. Also in New Hampshire, there's no sales tax, which is kind of cool. When I was there over the summertime, you go in to buy something. If it says $5, you hand them $5. It's crazy. The rest of the states take a variety of approaches on taxing retirement income. Some tax all retirement income, including Social Security. Others exempt Social Security, but tax sources such as pensions and retirement account income if retirees' income exceeds a certain cap. But the following states levy no tax on retirement income of any sort. 11 states that don't tax retirement income are Alaska, no state income tax. 2, Florida. Illinois, retirement income is exempt, including Social Security and pension, and IRA and 401k. Mississippi, retirement income is exempt, including Social Security, pension, IRA, and 401k. Nevada, no state income tax. Pennsylvania, retirement income is exempt, including Social Security, pension, IRA, and 401k. South Dakota, no state income tax. 8 is Tennessee, no state income tax. Number 9, Texas, no state income tax. 10, Washington, no state income tax. And Wyoming, no state income tax. Some states that don't appear on this list of those that don't tax retirement income at all are still relatively generous when it comes to letting retirees off the tax hook. For instance, Georgia does not tax Social Security retirement benefits and also provides a deduction of $65,000 per person on all types of retirement income. Also in Pennsylvania, all Social Security benefits and IRA and 401k income is exempt, and the Keystone State does not levy income tax on pension payments for those over 60. Clearly, state taxation of retirement income is somewhat complicated. One of the biggest differences between states is a variety of income caps to qualify for exemptions. In addition, state taxation of retirement benefits is a moving target. State tax laws change over time. For instance, New Hampshire's 5% tax on dividends and interest is due to be phased out by January of 27. Until then, the tax rate on dividend and interest income in New Hampshire declines every year until it reaches 0. So some good information there. So just some food for thought. And that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And see you guys next time. Bye-bye.